You're not losing money because you're stupid. You're losing money because you're listening to the wrong language. While amateurs chase headlines and hot tips, professionals read what Livermore called the tape. 4 silent signals that telegraph every major turn before the crowd realizes what's happening. Here's the brutal truth. If you trade on opinions instead of these signals, you'll donate 25–40% of your account at every major inflection point. You'll call it bad luck. It's not. It's illiteracy. The market speaks in price, volume, and behavior. Professionals translate it into risk, timing, and position size. They act when character changes, not when television anchors give permission. Jesse Livermore made and lost over $100 million in his lifetime, nearly $3 billion in today's money. But here's what separated his legendary wins from his devastating losses. When he won big, he wasn't reacting to what the market was doing. He was positioned for what it was about to do, based on 4 specific behavioral patterns that preceded every major turn of his era. Livermore understood a fundamental truth that destroys most trading accounts. Profit is paid to the patient. Tuition is demanded from the impulsive. You can keep funding the market scholarship program, or you can learn the language that saved Livermore from ruin and positioned him ahead of the century's biggest moves. Think about your last breakout chase. Price pushed above resistance. Your fear of missing out overrode your plan, and you clicked buy half a second after the pop. Then came the hesitation. The candle stalled. The pullback didn't bounce. You moved your stop loss just a little, hoping the tape would forgive your impatience. It didn't. Professionals were already selling into your urgency. They saw the failing follow-through 3 sessions earlier. Amateurs see a breakout and chase it. Professionals saw the breakout failing before it happened and were already positioned for the reversal. Amateurs panic when markets crash. Professionals were already in cash, watching for the exact moment institutional money would return. This isn't luck or intuition, it's pattern recognition trained on the only data that matters. How smart money telegraphs its intentions through subtle changes in market character. Consider this. In 1907, while newspapers celebrated railroad prosperity and financial magazines proclaimed a new era of American industrial dominance, Livermore quietly built his largest short position in Union Pacific. The stock was trading near all-time highs. Earnings were strong. Every fundamental metric suggested continued growth. Yet Livermore was betting against it with position sizes that would either make him wealthy beyond imagination or destroy his trading capital completely. He didn't have access to economic data, computers, or 24-hour news cycles. He couldn't analyze quarterly reports or study Federal Reserve policy. He didn't have CNBC talking heads explaining market movements or sophisticated charting software highlighting support and resistance levels. Yet he spotted the turn months before it materialized, using 4 silent signals that revealed when smart money was rotating out while dumb money was rotating in. The first signal appears in the most unlikely place, not in the stocks making headlines, but in the market leaders that should be moving but aren't. When the generals refuse to advance, the army is already in retreat. Livermore noticed that while Union Pacific maintained its highs, other railroad leaders like Northern Pacific and Reading were printing lower highs on increasing volume. The sector was fracturing from within, even as media celebrated surface strength. This leadership divergence is so subtle that 95% of traders dismiss it as coincidence. Yet it's the foundation everything else builds upon. The second signal emerges during peak confidence, when volume patterns reveal institutional distribution despite rising prices. This is the most dangerous moment for amateur traders because everything feels bullish. Prices are rising, sentiment is optimistic, and anyone questioning the trend looks foolish. But underneath the surface celebration, smart money is quietly exiting positions, using retail enthusiasm as liquidity for their distribution. When good news stops lifting prices, or bad news stops sinking them, the tape is confessing that a major turn is imminent. Livermore saw this throughout summer. 1,907 stocks, making marginal new highs on decreasing volume, while printing distribution days that revealed institutional selling. The third signal provides the precise level where the new trend confirms itself. Livermore called this the pivotal point. Not a prediction or guess, but a specific price level where the market reveals its true intentions. A market turn isn't a prediction. It's a price level. For Union Pacific, that level was $158 per share. Above that price, bulls maintained control. Below it, bears would take command. Livermore didn't predict which direction the stock would break. He identified the battleground and prepared for both scenarios. You don't guess the pivot. You let the tape draw it, then pay for confirmation. The fourth signal, Livermore's secret weapon for scaling position size, validates whether the turn has real conviction or is just another head fake. Even professional traders get fooled by one-day wonders and false breakouts. The difference is, they have systems to distinguish between genuine institutional commitment and temporary noise. Livermore developed what we'll call the 72-hour truth test. Genuine trend changes persist across multiple sessions and different market conditions. 1 day is opinion. 3 days are evidence. These 4 signals work because they're based on market structure, not market opinion. They reveal the behavior of institutional money, the only participants with enough capital to create sustained trends. When pension funds, insurance companies, and investment banks change positioning, they leave traces in price action, volume patterns, and leadership rotation. These traces become visible weeks or months before fundamental reasons become public knowledge. Your edge isn't speed, it's sequence. Most accounts don't die from one bad decision. They die from 1,000 small capitulations, moving stops, averaging down losers, doubling position size to recover what fear and greed just stole. Amateurs negotiate with the tape. Professionals accept its verdict and move on. Rule: never argue with new information. You are not married to a ticker. You are married to process. Identity is the quiet edge that compounds. Amateurs identify as stock pickers. Professionals identify as risk managers. The tape has grammar. It uses verbs like thrust, stall, absorb. It whispers through tails and wicks. It shouts through gaps and climaxes. When leaders should lift and fail, the grammar changes. When laggards should sink and refuse, the grammar changes. Livermore listened for these verbs. He graded behavior, not stories. Maxim: price up plus weak internals equals caution. Price down plus strong internals equals watch list. Master these 4 signals, and you'll never again wonder whether you're early, late, or completely wrong about market direction. You'll stop trading emotions and start trading institutional footprints. You'll position ahead of major moves instead of chasing them. You'll cut losses quickly when signals prove wrong, and scale positions aggressively when they prove right. Most importantly, you'll develop patience to wait for high-probability setups instead of forcing trades based on boredom or fear of missing out. Ignore them, and you'll keep making the same expensive mistakes that cost most traders their accounts within 2 years. You'll buy tops because they look strong and sell bottoms because they feel weak. You'll overtrade during quiet periods and undertrade during explosive moves. You'll confuse activity with progress and mistake opinions for analysis. But here's your warning. The first signal is so subtle that 95% of traders dismiss it as randomness. When market leaders fail to confirm index advances, most traders assume it's temporary sector rotation. They don't recognize it as the early warning system preceding every major market turn. Without understanding leadership divergence, you'll miss the setup for the other 3 signals entirely. So let's begin where almost everyone fails. The generals who won't march. Professionals don't trade the index. They trade the behavior of market leaders versus the index. When the S&P makes a marginal new high, your job isn't to celebrate. It's to ask whether the true generals confirmed the advance. If market leaders refuse to participate, the campaign is already over. This is signal 1. Leadership divergence. The earliest whisper that institutional money is changing sides while retail money celebrates surface strength. Amateurs anchor to the headline number, mesmerized by green candles and rising averages. Professionals anchor to leadership character because they understand a fundamental truth. You cannot have a sustained market advance without the strongest stocks participating, just as you cannot have a sustained decline if the most resilient stocks refuse to fall. The index is a mathematical illusion that can be manipulated by a handful of large-cap stocks while the majority of the market deteriorates underneath. Smart money knows this. They watch leadership behavior because leaders reveal institutional intentions weeks before those intentions become obvious in earnings reports or economic headlines. When you trade leadership divergence, you're trading institutional footprints, not media narratives. You're reading the language of real money, not the opinions of talking heads. In early 1929, while the Dow Jones pushed to fresh highs and newspapers proclaimed the dawn of permanent prosperity, Livermore noticed something deeply disturbing. The financial press was awash with optimism, touting the new era where stock prices would only rise. Retail investors quit their jobs to become full-time speculators. Yet the previous leaders, the stocks that had powered the bull run for years, giants like RCA, General Motors, and Montgomery Ward, were printing lower highs and accumulating distribution days. High volume, weak closes, institutional selling disguised as normal market activity. These weren't random fluctuations or temporary sector rotation. They were systematic liquidation patterns that preceded every major market collapse in Livermore's experience. Livermore observed heavy volume on days where these bellwethers would close in the lower 25% of their daily range, indicating institutional selling into strength. This wasn't profit-taking by small investors. This was smart money systematically offloading positions to optimistic buyers. The public celebrated each new index milestone. Livermore, reading the tape, started building his legendary short position. He wasn't being contrarian for the sake of it. He was responding to the silent signals that revealed when smart money was rotating out while dumb money was rotating in. Here's how leadership divergence works. When your top 10 to 15 relative strength leaders fail to confirm new index highs, or when laggards refuse to make new lows during market weakness, you're witnessing the early stages of a major reversal. Smart money moves like a glacier slowly, deliberately, with massive force. When Goldman Sachs decides to distribute 100,000 shares of a leading stock, they don't announce it on CNBC or execute it in one block trade. They spread that selling across weeks, absorbing every optimistic buyer who thinks each dip represents opportunity. The stock might even rally during this distribution, as retail enthusiasm temporarily overwhelms institutional selling. But the character has changed. Volume increases on down days and decreases on up days. Closes migrate toward the lower portion of daily ranges. Support levels that previously held start showing cracks. The psychology behind this divergence is straightforward. Institutional money rotates out of leadership positions before rotating out of the broader market. When Fidelity decides to reduce its Microsoft position from 3% to 1% of assets under management, that selling pressure doesn't appear overnight. It gets spread across weeks or months, disguised as normal trading volume. The fund managers aren't trying to crash the stock. They're trying to exit without moving the price against themselves. But their footprints remain visible to anyone watching for distribution patterns. Protocol for signal hash shown requires systematic execution, not emotional interpretation. First, build a watch list of 10 to 15 true leaders by 3-month relative strength, not market cap or brand recognition. Use a simple formula: price change over the last 60 trading days, divided by the index change. Rank from highest to lowest. These are the current market favorites, where institutional money has been concentrated. Leadership rotates. Yesterday's generals become today's laggards. Second, track whether leaders confirm or diverge at major index inflection points. When the S&P makes a new 52-week high, count how many of your generals make new highs within 2 sessions on rising volume. If fewer than 40% confirm, treat the move as suspect. Third, count distribution days on leaders. High volume plus closes in the lower 25% of the daily range. 1 distribution day means nothing. 2 suggests caution. 3 distribution days within 2 weeks while the index advances signal that smart money is rotating out of leadership positions. Fourth, if leaders diverge for 2 to 3 sessions while the index advances, immediately cut position size by 50% and raise stop losses to break even. This isn't market timing, it's risk management based on institutional behavior patterns. Cancel new buys. Waiting is a position. Your primary job becomes survival, not speculation. Fifth, maintain defensive posture until a pivotal point confirms new leadership or validates the divergence. Don't try to pick bottoms or fight the trend. Cash becomes your largest position. Patience becomes your competitive advantage over traders who feel compelled to stay fully invested regardless of conditions. The flip side is equally powerful and often more profitable. During market weakness, watch for leaders that refuse to make new lows. These become your candidates for the next campaign when conditions improve. Consider March 2020. While the S&P dropped 35% in 5 weeks, certain technology leaders like Zoom and Netflix held their ground or even advanced. Amateur traders saw this as irrational behavior during a pandemic-driven collapse. Professional traders recognized it as institutional accumulation of companies positioned to benefit from lockdown policies. Those stocks became the leaders of the subsequent bull market because smart money had already identified and accumulated them during maximum pessimism. When the index makes a new closing low, tally how many of your watch list names hold above their prior swing lows on average volume or less. If more than half hold, risk is leaving the system. That's not a buy signal by itself. It's a map showing you where strength lives, so you can act decisively after confirmation. Leadership divergence works across all time frames and market conditions. In bull markets, it warns when the advance is losing institutional support. In bear markets, it identifies which stocks will lead the next recovery. In sideways markets, it reveals sector rotation before it becomes obvious. The pattern remains consistent. Institutions move first, retail follows, media explains what already happened. Maxim: when the generals retreat, the army will follow. When the generals hold ground, reinforcements are coming. This isn't metaphor, it's market structure. Leadership stocks represent concentrated institutional ownership. When those institutions change their minds about market direction, they change their positions in leadership stocks first. The broader market follows with a lag that can span weeks or months. Amateur traders anchor to index performance because it feels safer and requires less work. They buy index funds and celebrate when the S&P hits new highs without checking whether those highs are confirmed by broad participation or driven by a handful of megacap stocks. Professionals anchor to leadership behavior because it provides earlier warning signals and better risk-adjusted returns. This single shift in focus can save you 25% during late-stage market turns when amateur money is still buying, while professional money has already rotated to cash. But leadership divergence only tells you change is coming, not when it will arrive. That's where signal #2 becomes critical, and it appears during the most dangerous moment for amateur traders: peak confidence. Signal 2 appears at the exact moment when being wrong feels impossible. This is precisely when you're in maximum danger. Amateurs trade headlines. Professionals trade the market's reaction to headlines. When good news stops moving prices up, or bad news stops moving prices down, the tape is confessing that a major turn is imminent. This is the confidence trap that destroys more accounts than any other psychological phenomenon. It strikes when optimism reaches fever pitch and every fundamental metric supports continued price appreciation. You feel smart. Your positions are working. The media validates your thesis daily. This is exactly when institutional money begins its silent rotation out of your positions. The confidence trap exploits the most dangerous assumption in trading: that current conditions will persist indefinitely. When Apple beats earnings by 15% for the third consecutive quarter, amateur traders increase position sizes and extend time horizons. Professional traders recognize these moments as maximum risk periods because prices discount future expectations, not current conditions. Your edge isn't predicting headlines. Your edge is reading the market's authentic response when those headlines hit the tape. Picture September 1929, the apex of American financial euphoria. Newspapers proclaimed the new era of permanent prosperity, with headlines celebrating capitalism's triumph over economic cycles. Investment trusts launched weekly to meet insatiable public demand for stock exposure. Your neighbors quit stable jobs to become full-time speculators, convinced that stock prices would rise indefinitely. Margin buying reached historic levels as retail investors leveraged themselves to maximum capacity. Everyone was making money. The few remaining bears were ridiculed as relics who didn't understand the modern economy. This is precisely when Livermore accelerated his short position. Not because he was contrarian by nature, but because he recognized the news reaction inversion pattern. While newspapers celebrated each new high with increasingly hyperbolic language, Livermore watched how individual stocks responded to genuinely positive developments. Companies would report record profits, announce expansion plans, or receive analyst upgrades. Yet their stock prices would gap up modestly at the open, then fade throughout the session to close near unchanged or negative on heavy volume. Consider RCA in late summer 1929. The company reported a 40% increase in radio sales and announced plans for television broadcasting. The stock gapped up 2.8% at the open on this spectacular news. By noon, it had pushed another 1.2% higher. Amateur traders celebrated the confirmation of their bullish thesis, but professional money was quietly distributing. By the close, RCA finished down 0.6% from the previous day on the heaviest volume in 6 months. That wasn't profit-taking by small investors. That was smart money using good news as cover to distribute large positions to optimistic retail buyers. Here's how Signal 2 manifests in modern markets. Rising prices fail to respond to increasingly bullish news, while volume reveals institutional distribution despite surface optimism. A technology company beats earnings by 20%, raises forward guidance, and announces a major product launch. In a healthy market, this combination drives the stock to new highs on expanding volume. Instead, you observe a 3% gap up at the open, followed by steady selling pressure throughout the session. The stock closes red on volume 50% above average. Amateur traders dismiss this as normal consolidation. Professional traders recognize it as institutional distribution disguised as celebration. The institutional logic is straightforward. When Fidelity needs to reduce a $500 million Microsoft position, they can't execute that sale during normal conditions without moving price against themselves. But when Microsoft reports exceptional earnings and retail enthusiasm spikes, they can distribute shares into that enthusiasm without creating obvious selling pressure. The gap up provides liquidity for sellers, not confirmation for buyers. Volume patterns reveal what price action disguises. Distribution days combine above average volume with closes in the lower portion of the daily range, especially following positive catalysts. When a stock gaps up 2% on earnings, trades as high as 3.5% during the session, but closes up only 0.5% on heavy volume, institutional money is rotating out while retail money rotates in. Smart money sells into hope. They let optimism provide liquidity for their exits. The flip side is equally telling and often more profitable. During market weakness, watch for stocks that refuse to fall on genuinely bad news. A company misses earnings by 22%, lowers guidance, and announces layoffs. In a healthy bear market, this combination drives the stock to new lows on expanding volume. Instead, you observe a 4% gap down at the open, followed by steady buying pressure throughout the session. The stock recovers to finish green on strong volume. That's accumulation disguised as selling pressure. Smart money uses bad news as cover to accumulate shares from pessimistic sellers who interpret the earnings miss as validation of their bearish thesis. Protocol for Signal 2 requires systematic tracking across multiple time frames. First, mark major news events on your charts. Earnings announcements, economic data releases, Federal Reserve statements, guidance revisions. These events create expectation gaps between what should happen and what actually happens in price action. Second, use a 48 to 72-hour window to judge authentic reaction versus initial noise. Markets often overreact immediately as algorithms create temporary distortions. True institutional response emerges over the subsequent sessions as real money makes calculated decisions. Third, identify good news that fails to create new highs within 2 to 3 sessions as bearish divergence. When a stock receives genuinely positive news but cannot exceed its prior high within 3 sessions on increasing volume, institutional money is likely rotating out. Fourth, identify bad news that fails to create new lows within 2 to 3 sessions as bullish divergence. When a stock receives genuinely negative news but holds above its prior low, institutional money is likely accumulating. Fifth, require volume confirmation for all signals. Distribution patterns require above-average volume because institutions need liquidity to exit large positions. Accumulation patterns often occur on below-average volume because institutions can accumulate gradually without creating obvious buying pressure. Sixth, position size conservatively on initial signals. 0.5 to 1% account risk per position. News reaction inversion identifies potential turning points but doesn't guarantee immediate trend changes. Scale only after. Pivotal point confirmation validates the signal with decisive price action. The psychology behind news reaction inversion reflects the forward-looking nature of financial markets. Stock prices represent collective expectations about future cash flows, not current business conditions. When Apple reports record iPhone sales, that information was likely anticipated by institutional investors months earlier through supply chain analysis and consumer surveys. The earnings announcement confirms what smart money already knew and positioned for. If the stock fails to rally on the good news, all the buyers who were going to buy have already bought. The only participants left are sellers looking to monetize positions into retail enthusiasm. This dynamic explains why markets often peak on the best possible news and bottom on the worst possible news. The best news represents maximum optimism and complete buyer exhaustion. The worst news represents maximum pessimism and complete seller exhaustion. Professional traders position for these reversals by reading market response to news flow rather than the news itself. It's CERNed, professional traders, maxim. The tape speaks louder than headlines. Trade the market's response, not the announcement. This principle separates professionals from amateurs across all markets and time frames. Amateur traders read headlines and assume logical price responses. Professional traders watch how prices actually respond and adjust positioning accordingly. This signal works because markets are forward-looking mechanisms that discount future expectations continuously. When all the buyers have bought on good news, or all the sellers have sold on bad news, the only direction left is reversal. The confidence trap captures traders at these inflection points by making the wrong decision feel obviously correct based on fundamental analysis, while the tape reveals institutional money moving in the opposite direction. But signal 2 tells you a turn is forming, not when it will. Trigger. That requires signal 3, Livermore's pivotal point system. A market turn isn't a prediction, it's a price level. Livermore called it the pivotal point, the specific price where the market confirms a new line of least resistance. You don't guess the pivot. You let the tape draw it. Then you pay for confirmation. This is where patience transforms into precision. This is signal 3, the bridge between anticipation and action. While amateurs try to predict turning points, professionals respond to them. While amateurs buy because they feel bullish or sell because they think it's topped, professionals wait for the market's own definition of where the new trend begins. Your edge isn't prophecy. It's process. The difference between surviving and thriving comes down to this. You either trade levels or you trade feelings. Feelings lie. Levels don't. Amateurs identify as stock pickers and fortune tellers. Professionals identify as risk managers and tape readers. Identity precedes behavior. When you see yourself as a guardian of capital, You respect the pivot because it protects you from guessing. When you see yourself as a hero, you jump first and pray later. In late 1907, after Union Pacific had been declining for months during what would become the Panic of 1907, Livermore watched for a specific pattern that would signal the stock's character had fundamentally changed. He wasn't trying to catch a falling knife or predict when the selling would exhaust itself. He was waiting for the tape to reveal when smart money shifted from distribution to accumulation through decisive price action. The pattern emerged with brutal clarity. Union Pacific opened at $165, immediately plunged to $140 on panic selling as margin calls forced liquidation, then staged a dramatic recovery to close at $158 on the heaviest volume in 6 months. This wasn't random noise or short covering. This was institutional money, stepping in to absorb panic selling at prices they considered attractive. The wide range from $165 to $140 demonstrated genuine two-sided warfare. The strong close at $158 revealed that buyers dominated sellers by session's end. Most importantly, the massive volume confirmed that real money was changing hands. That reversal day's high at $158 became Livermore's pivotal point. Above $158, Union Pacific would confirm that character had flipped from distribution to accumulation. Below $158, the stock remained vulnerable as selling pressure overwhelmed buying interest. Livermore didn't buy at the close of the reversal day. He marked $158 as his line in the sand and waited 3 sessions for the market to prove his analysis correct. When Union Pacific cleared $158 on expanding volume with strong breadth participation from other railroad stocks, Livermore knew the balance of power had shifted. Smart money was no longer selling into strength. They were buying weakness and accumulating positions for the next major campaign. The pivotal point break provided objective confirmation that removed guesswork from position timing. Here's how pivotal points work across all markets and time frames. After Signal 1, leadership divergence, and Signal 2, news reaction inversion, have prepared you for a potential turn, Signal 3 provides the exact level where you stop waiting and start risking. For bottoms, the pivot is the high of the key reversal day. For tops, it's the low of the key distribution day. This system works because it's based on actual supply and demand dynamics, not theoretical predictions. The protocol for Signal 3 demands systematic execution without emotional interpretation. First, identify the reversal day through specific criteria. Wide range, at least 150% of the 20-day average, 100, and all-time, heavy volume, at least 200% of the 10-day average, and strong close in the direction of the potential new trend. Top 25% of range for bottoms, bottom 25% for tops. These criteria ensure you're identifying genuine institutional activity, not random volatility. Second, mark the pivot level precisely. For potential bottoms, use the exact high of the reversal day. For potential tops, use the exact low. Don't round numbers or use arbitrary support and resistance levels. The market will test this precise level to determine whether the reversal represented genuine character change or temporary noise. Third, demand character confirmation before entering positions. Volume must be at least 50% above the 10-day average on the pivotal point break. Range expansion should continue, demonstrating momentum behind the new trend. Breadth participation from related stocks confirms broad institutional rotation rather than isolated speculation. Fourth, enter only on the break of the pivot. Never before. This is the most difficult discipline for amateur traders who want to get in early or buy at better prices. Professional traders pay for confirmation because being early and being wrong produce identical financial results. The few cents saved by anticipating the break are meaningless compared to capital preserved by waiting for validation. Fifth, manage risk systematically. Position size should represent 0.5 to 1% account risk. calculated as the difference between entry price and stop-loss level. Place stops just beyond the pivot with a 2 to 3% buffer for normal volatility. For long positions, stops go below the pivot low. For short positions, stops go above the pivot high. Sixth, trail stops aggressively once the pivot holds for 3 or more sessions. Move stops to break even after the first week, then trail at 50% of the distance from entry to current price as positions move favorably. This protects profits while allowing trends room to develop. The beauty of pivotal points is complete emotion removal from entry timing. You're not buying hope or selling fear. You're responding to the market's own definition of trend change based on supply and demand dynamics revealed through price and volume action. When a stock breaks above its pivot on strong volume, institutional buyers have decided the risk-reward ratio favors higher prices. You're not predicting these decisions. You're responding after they become visible. Consider a modern application. Tesla reports disappointing delivery numbers and gaps down 8% from $240 to $220 on heavy volume, then recovers to close at $235. That creates a potential pivotal point at $240. If Tesla subsequently breaks above $240 on expanding volume with broader electric vehicle participation, character has shifted from distribution to accumulation. The gap down created the reversal day. Recovery to $235 demonstrated buying interest, and the break above $240 confirms institutional commitment. This system works across assets and timeframes. Futures breaking weekly pivots often seed multi-month trends. Currency pairs clearing daily pivots fuel measured moves lasting weeks. Even intraday traders use 15-minute pivots to avoid choppy conditions. The principle remains constant. Pay for confirmation. Don't predict it. Maxim: the market owes you nothing until it crosses the pivot. Then it owes you discipline. This keeps you patient during setup phases and systematic during execution. The market doesn't care about your opinions or financial needs. It only responds to actual supply and demand forces. The pivotal point system harnesses those forces by identifying where they shift direction. But here's the crucial insight that separates professionals from amateurs. One day can lie. Even clean, pivotal point breaks can fail if they lack genuine institutional conviction behind them. Algorithms create false breakouts. Short covering mimics accumulation. News-driven gaps reverse when catalysts prove temporary. That's why Livermore's biggest position sizes came only after Signal 4 confirmed the pivot had real staying power across multiple sessions and varying market conditions. Livermore's secret weapon wasn't just identifying pivotal points, it was knowing which ones had real institutional conviction behind them. He discovered that the next 72 hours after a pivot break revealed everything you needed to know about whether smart money was genuinely changing sides or just creating a head fake. This is Signal 4, the truth test that separates fleeting volatility from sustained trend change. While amateurs celebrate breakouts immediately, professionals interrogate them like detectives guarding capital. One day can lie through manipulation or coincidence. 3 days reveal character through consistency. Your edge isn't speed, it's verification. The difference between surviving and thriving comes down to this. Amateurs trade breakouts. Professionals trade follow-through. After Union Pacific cleared its $158 pivot in 1907, Livermore didn't immediately scale his position, despite the clean break on strong volume. He understood that even textbook setups could fail if they lacked genuine institutional backing. Instead, he watched the next 3 sessions like a surgeon monitoring a patient after critical surgery. Vitals, responses, and resilience under stress. Day 1, after the pivot break provided initial confirmation. Union Pacific closed strong at $162, holding comfortably above the $158 pivot level. This demonstrated that buyers remained in control after the breakout, but single-day strength meant nothing without persistence. Professionals don't celebrate on day 1. They grade performance across multiple sessions because institutions reveal their true intentions through sustained behavior, not momentary enthusiasm. Day 2 delivered the crucial test that separates real moves from fake ones. Union Pacific opened weak on railroad sector concerns as newspapers questioned the sustainability of recent rail recoveries. The stock dipped to $159, just $1 above the pivot, creating maximum anxiety for recent buyers. This was the moment when weak hands would abandon positions, and strong hands would reveal themselves through aggressive accumulation. Instead of collapsing back through the pivot, Union Pacific found determined buyers at $159, who absorbed all selling pressure and drove the stock to close at $164. The ability to recover from early weakness and finish strong demonstrated institutional commitment that transcended temporary headline concerns. Day 3 completed the pattern and provided final confirmation of character change. Union Pacific made a higher low at $161 and pushed to a higher close at $167, establishing the classic higher high, higher low structure that defines healthy uptrends. When negative news on day 2 couldn't push price back below the pivot, Livermore knew demand was firmly in control. The stock had passed the 72-hour truth test by demonstrating resilience across varying market conditions. That endurance told him real money had changed sides. Only then did he pyramid aggressively, adding to positions with conviction rather than hope. Here's how the truth test works across all markets and timeframes. Genuine trend changes persist across multiple sessions and different market conditions. They survive early morning weakness, absorb midday selling pressure, and extend gains on afternoon strength. They hold pivotal levels on light volume and accelerate on heavy volume. They ignore minor negative news and respond decisively to positive catalysts. Fake breakouts collapse quickly when faced with their first real test. They gap up on news, then fade throughout the session. They break pivots on strong volume but can't hold gains by the close. They reverse immediately when faced with contrary information because they lack institutional sponsorship. The protocol for Signal 4 requires systematic grading across 4 specific metrics during the 3 sessions following any pivot break. First, evaluate price structure by asking whether the stock is printing higher highs and higher lows for uptrends or lower highs and lower lows for downtrends. Each session should build on previous progress rather than giving back gains. This reveals whether momentum is building or deteriorating behind the surface move. Second, monitor close location within each session's daily range. For bullish moves, closes in the upper third indicate buying pressure throughout the session. For bearish moves, closes in the lower third suggest selling pressure despite any intraday strength. This metric distinguishes between genuine accumulation and distribution disguised as breakout activity. Strong closes demonstrate conviction. Weak closes reveal hesitation. Third, compare volume to the 10-day average throughout the test period. Expanding volume on favorable price action confirms institutional participation. Declining volume suggests the breakout lacks broad support and may reverse quickly. Volume patterns often diverge from price action during fake breakouts, as algorithms create price movement without genuine institutional backing. Fourth, assess news sensitivity by observing how the stock responds to unexpected information. Genuine trend changes ignore minor negative news and accelerate on positive catalysts. Failed breakouts reverse immediately on any contrary information because they lack institutional conviction to absorb selling pressure. This metric reveals whether the move has deep roots or shallow foundations. Apply the decision rule systematically without emotional interpretation. If 3 out of 4 metrics remain favorable for at least 2 out of 3 sessions, you have evidence of institutional conviction. This gives you permission to escalate position size by 25 to 50%, using identical risk parameters of 0.5 to 1% account risk per addition. You're not guessing or hoping. You're responding to proof that smart money is committed to the new direction. Consider Tesla breaking above $250 resistance after months of consolidation. Day 1 closes at $255 on heavy volume with a clean break. Day 2 opens weak on broader market concerns, dips to $251, but recovers to close at $258 in the upper third of range. Day 3 makes a higher low at $254 and closes at $262 with expanding volume. Price structure passes, close location passes, volume passes, news sensitivity passes. The 72-hour test reveals institutional commitment through persistence across varying conditions. Scale positions aggressively because evidence supports conviction. Contrast this with a false breakout scenario. Tesla breaks $250 and closes at $255 on day 1. Day 2 gaps down on delivery concerns and closes at $248, back below the pivot. Day 3 attempts recovery but closes at $249, still violating the pivotal level. Structure failed. Close location failed. Volume failed. News sensitivity failed. All 4 lights red. Exit immediately without debate, rationalization, or hope for recovery. The failure to hold pivotal levels reveals lack of institutional support. Trail stops to just under. This is life too. This is a portly 2 provided. The pivot once day 3 closes favorably, transforming the pivot from entry trigger into protective floor. Make it hard to lose money on a winning trade by protecting profits while giving trends room to develop. If the 72-hour test fails and price loses the pivot on a closing basis, exit immediately without negotiation. Cash is a position. Waiting is a position. Failed tests reveal that your analysis was wrong or premature. Accept the small loss and preserve capital for better opportunities. The psychology behind this system reflects institutional behavior patterns that remain constant across decades and market conditions. When Goldman Sachs commits $500 million to a new position, they don't change direction based on one day's price action or minor news flow. They show conviction through sustained activity across multiple sessions and varying headlines. Real rotation requires coordinated execution across desks, algorithms, and liquidity providers over time. That behavior leaves a rhythm. Higher lows after dips, support at pivots, volume surges on strength, calm during pullbacks. Retail enthusiasm can create one glorious day of price appreciation, but only institutional conviction can string together 3 resilient sessions that survive overnight fears and intraday probes. This is why waiting is a position and doing nothing is sometimes the best trade. In March 2020, violent rallies appeared daily only to fail by the next session. The moves that stuck past the 3rd-day test, refusing to give back pivots despite terrifying headlines about pandemic lockdowns and economic collapse. Why does 72 hours reveal institutional truth? Because real money cannot disguise persistence. A pension fund doesn't flip billions on headlines or whims. They phase orders, test liquidity, and defend levels through systematic execution that creates observable patterns across multiple sessions. The signature is endurance, not drama. Professionals learn to distrust fireworks and respect quiet accumulation that survives both overnight gaps and afternoon selling pressure. Maxims that anchor this final filter. 1 day is opinion. 3 days are evidence. This prevents premature position sizing based on single-session strength that may not persist. Professionals trade confirmation. Amateurs trade anticipation. This emphasizes responding to proven patterns rather than predicting outcomes based on hope or fear. Now you have the complete system that separated Livermore's legendary wins from his devastating losses. Signal 1, leadership divergence, alerts you that change is coming by revealing when institutional money rotates out of market leaders, while indexes make new highs. Signal 2, news reaction inversion, reveals direction by showing when good news fails to lift prices, or bad news fails to sink them. Signal 3, the pivotal point, draws the precise line where trends change character, providing objective entry levels. Signal 4, the 72-hour truth test, gives you permission to press your edge with conviction by confirming institutional commitment behind breakouts. Cut losses fast when you're wrong. Size small until you're proven right. Wait for all 4 signals to align rather than forcing trades based on impatience or boredom. Own your process. not your positions. Identity drives behavior. See yourself as a guardian of capital, not a collector of predictions. If you've learned to read these silent signals that telegraph institutional intentions, the next lesson on position sizing and pyramiding will show you how to maximize profits when the market validates your patience with institutional grade moves that compound wealth systematically rather than accidentally.